Good evening, everyone. Want to do our best to stay on time here tonight. If we have a few stragglers, no big deal. But a lot of stuff to get through. Was fortunate enough, as I asked in our letter, to invite all of you to get some great questions. So I'm going to do my best to try to touch on some of that tonight. If we've got time for it, some Q&A. Again, we'll see how we do here. We'll try to stay on time. We did have time in the morning, and I guess we'd probably get there as well tonight. If we don't get to a question, or if we don't get to your question, feel free to grab any one of us after and ask. If you aren't comfortable asking in the room, again, happy to kind of touch base as we go here. So I want to just start by, I guess, first and foremost, thanking the Brewers for not playing this evening. I think attendance probably would have been considerably lighter if we were dealing with not only that traffic, but also probably many of you that want to be there. So a big, I think, disappointment so far in this round, but certainly happy to have them go as far as they've gone so far. But also a big thanks to our staff, to the folks here out at the Ingleside. None of this happens without their contributions, in particular to my own team that certainly picked up a lot of slack on my behalf while I was preparing for this. And again, to all of your advisors, their teams, who no doubt have been overwhelmed with phone calls and questions and all the things that usually happen, not only at this time of year, but in the lead up to this seminar. So again, can't thank them enough. I would be remiss if I didn't start this evening's presentation with a reminder that all of what we are about to talk about comes under an immense fog. There certainly is no shortage of uncertainty out there right now, not the least of which a government shutdown that drags on, that is calling into question some of the economic data we usually rely on. We have a Bureau of Labor Statistics that did not publish a labor report for the last month. They have had to call back now workers to come up with a CPI report, a Consumer Price Index report, for the month of September. For those of you in the audience already on Social Security, you know that your Social Security cost of living adjustment, normally coming out right around the end of October, that's not going to happen without the September CPI number. And so one of the big reasons why those employees got called back was simply so that you all could know what cost of living adjustment to expect from your Social Security next year. So again, everything that I'm about to say carries the weight of that fog that hangs over us. And part of the deal here, I think, is that when you're driving through fog, it's kind of important to know where you were. It's kind of important to know where you are, because at the end of the day, the only way you're going to get where you're going is if at least you have that starting point. And so a lot of my comments this evening are simply geared towards trying to put some clarity on where are we right now, where have we been, and then I think we can move on to the next part of that conversation, which is where are we going. All right, so to be clear, the economy continues to grow. It has been slow and steady. I would argue slower than it has, certainly, but it is in a phase of, it remains in a phase of growth. Of course, a lot of that is coming by a significant technological spend, a spend that we have certainly seen before at another time in which I might argue the title of a seminar could have, and actually was, Investing Amid Uncertainty. Could just as easily have been the title of our seminar this evening. But going back a number of years to the kind of wake of the technology bubble, late 1990s, early 2000s, very similar in a lot of ways to the story that I think you're going to hear this evening. Some pretty significant differences as well. But it isn't strictly technology spend that is driving the economy right now. I would add that consumer spending remains quite strong, despite the fact that when we look at any number of surveys of the consumers broadly say they don't feel great about the way things are and where things are headed. A lot of that tied to inflation, a lot of that tied to just general misperceptions about where we are economically. The real issue, I think, is that the Federal Reserve is meaningfully challenged by a dual mandate of full employment and price stability. You all know well that inflation continues to be the kind of thread that has maybe worn some of us thin. At the same time, we are now seeing a slowing labor market those two competing objectives, really the two focuses of the Federal Reserve by congressional mandate, they are the things most relevant, I think, to the conversation with respect to the direction for interest rates, but also the economy more broadly. And then would be remiss if I didn't add, and for those of you who have been in the office since early April, you've seen on the very performance report, the very first page that we give you, the pullback in the stock market going back to March and early April around the tariff conversation. Tariffs certainly have weighed on the labor market, inflation, as well as global trade. All right, so I'm going to do my best not to throw too many data points at you tonight, but I do think, again, that as part of understanding where are we need some of that. And so, to be clear, GDP continues to grow slowly. If you look at the forecast for 2025 from the Federal Reserve, GDP growth expected to be 1.6% this year. As we look into 2026 and 2027, 1.8% next year, 1.9% the year thereafter. Clearly a lot of noise in those projections, but at least with where we've come from and where we currently are, the economy is growing right around long-term averages, average since 2000, about 2.2%. We're a little behind that right now, but certainly within the ballpark. I think part of the challenge, though, is we have seen some meaningful slowing in recent quarters, and especially in the labor market. When I mentioned a little bit earlier that we could just as easily call this investing amid uncertainty, well, sure enough, Bob Landaas put on this very seminar, or a version of it, going back to May of 2001. And again, a lot of that was in kind of the immediate aftermath and recovery from the tech bubble. Well, as you can see here, prior booms had been led by consumer demand going back then, but we were in a market that seemed to be driven by technological spend. And again, I think that is a lot of what we are seeing right now. We'll touch on that a little more completely, but worth noting that for full year 2025, spending on artificial intelligence alone from the hyperscalers, so those businesses which really build out the infrastructure for artificial intelligence processing, somewhere on the order of $350 to $400 billion. When we look at forecasts for artificial intelligence spending over the next 10 years, rough estimates are we should see $7 trillion spent on artificial intelligence alone. Over the next 10 years, that equates to about 1% to 2% contribution, additional contribution to GDP growth. So in addition to all the other things we do in our country, this new spend is set, I think, to help continue to boost economic activity. It is a real thing coming from businesses with strong earnings. This is not fly-by-night businesses that don't have revenue, that don't have cash flow, that don't have a way to spend that money. They are spending money that they have earned over many years, selling products that you all know well, and they have committed the money you bought in on those products now to developing what drives productivity going forward. I'm going to come back to that word productivity in a minute, but productivity really is at the heart of this conversation. As an economy, we can't grow without one of two things, and ideally both. We need more workers. Again, we'll come back to that one. Or we make our workers more productive. The miracle of, I think, the U.S. economy going back the last 150 or 200 years, and those of you that heard me talk over the last couple of years have heard this before, but businesses' inability to drive innovation that makes workers more productive, innovation that ultimately drives economic growth. I was talking to Miller Coors employee after our first seminar, and a lot of conversation on AI tonight, so it'll I think hit a little heavier, but he mentioned that going back 15 years, they had intelligent systems in the warehouses that could take forklifts and move them to where the product was, pick up the product and move it to the place it needed to be. You didn't need individuals to drive those forklifts because, as I was informed, I had no idea, those forklifts don't have suspension. And so if you drive a forklift for any meaningful amount of time, you're going to be probably dealing with some back problems. Well, if you've got a forklift that can drive itself, you are not dealing with workers' comp claims, you're not dealing with any of the other burden that comes from having a worker out and trying to fill in. And so, reasonably, that was kind of some of the early innings of what we are seeing now. Today's artificial intelligence is vastly different than those early conversations. we have had for a very long time specific applications of technology that we otherwise maybe would have attributed to artificial intelligence. What we are dealing with today are basically computer systems that can think, that can apply themselves much more generally than we have ever seen before. That comes with all kinds of nightmares, don't get me wrong, but it also solves a lot of problems. And so when I say that we are investing in uncertain times, understand that this is not the first time we've done that. In fact, that is kind of the mantra of being an investor. All right, so I mentioned that household finances and the consumer overall remain quite strong. A couple of exceptions. We are seeing some weakness recently in subprime auto loans, and especially for younger borrowers. So to be clear, this room is 3 years younger than our morning seminar, so thank you all. But reasonably, our population as a whole has aged, and it has aged rather quickly. 4.5 million Americans turned 65 this year, 4.1 million turned 65 last year. We have reached peak 65. And as you all know well, there comes a point in your life in which you don't need to, you don't want to, you can't work anymore. We know on average that's about 65. And so it comes as no surprise that households, by and large, they're not working as much as they used to, and many households are seeing those workers leave in droves. And so when we look at household finances, that kind of orange-ish line here is household net worth. Well, net worth has been rising dramatically, in part because of markets, in part because your home values are up, in part because, well, you all have spent your whole life, and I say you all, again, 3 years younger than the morning seminar, but the average age in here still is 72. So that is consistent with the part of your life in which you have accumulated the vast majority of your wealth. On the other hand, on average, household debt service, not a problem. Household debt service simply, how much burden do I have as a household in financing and paying for my debt relative to my income, relative to my wage? And so there isn't this massive problem out there for household spending. And we do have this tailwind, I talked about this a little bit last year, but we do have this tailwind from a population which has aged to the point where they don't need to think about whether or not they're going to spend anymore. My grandfather was a Lutheran pastor for many, many years, passed away a couple of years ago, but in his retired years, retirement for a Lutheran pastor still means, yeah, you're on call somewhat regularly, but in his retirement years, he used to tell me, you know, Kyle, I'm on a fixed income and it's fixed too low. And I think that rings fairly true, except that it also meant that he knew precisely where his spending was going to come from. He knew precisely month to month what those dollars were going to look like, and he knew where they were going to go. And so there is this floor now to consumer spending that is not purely tied to the labor market the way it used to be tied to the labor market. So when I tell you that labor growth in our country is stalling, which is a fair statement, we have seen a meaningful drop-off in payroll growth in recent months. In fact, in the months of June, July, and August, about 30,000 people added to non-farm payrolls in our country per month. That is woefully below longer-term averages. But when I tell you that labor market growth is stalling, it may not directly tie back to the other piece of our economy that is so important, consumer spending. 2/3 to 70% of our economic activity is consumer spending, because fewer and fewer people in our country are looking for work. There's another big reason beyond the aging population, though, why the labor market growth is slowing. We've seen 1.9 million foreign-born citizens leave our country. This is not a political statement. This is a statement of fact. 1.9 million foreign-born citizens have left the country from May to August. In that period of time, the workforce in our country shrunk by 1.5 million Americans. Again, I am not making a statement of judgment here. You can take that for what it is worth, that the workforce itself has shrunk. And so when I say that labor market growth is stalling, a big reason for that is that a lot of the workforce has left. The rest of it, well, they've gotten to a point where they don't need to work anymore. So if the Fed's focus is labor, well, the tools they have generally interest rates, aren't all that powerful of a tool for a labor market that has aged and is leaving the country. On the other hand, we are dealing with inflation that remains sticky. We have not reached the 2% target. And so when we talk about the direction that the Federal Reserve should take for interest rates, well, generally speaking, higher interest rates, more restrictive rate policy tends to work fairly well against inflation. On the other hand, cutting rates, which would generally stimulate the labor market, isn't a terribly strong tool for the problems that we currently have in our labor market. When we look at inflation, a couple of very specific areas are the problem: shelter, food, and medical care. Many of you may have seen an article today or have already heard from your Medicare supplement providers that your policy is going to be changing. There is no doubt that medical costs have gone up, and insurers everywhere are trying to figure out how to navigate those problems. If you have long-term care insurance, if you have those supplemental policies, expect that things look a little different. And I've had a lot of conversations in the last year or two on what that means. The good news is you've seen strong portfolio growth that's maybe made that less of a burden. On the other hand, if you're on a fixed income and it's fixed too low, that inflation hits a little harder. As I mentioned, tariffs as a whole weigh on both labor and inflation. If you are a business, take an automotive manufacturer, for example, and you are uncertain about the direction of trade policy in our country, and again, a lot of good and bad about trade, a lot of good and bad about tariffs overall, but if you don't know what policies are going to be set, it's really hard to make decisions about where you're going to build your next product. It's really hard to make decisions about what the future looks like until you have clarity. So the free trade agreement that replaced the North American Free Trade Agreement, renegotiated in Trump's first term between Mexico, the US, and Canada, took 18 months to negotiate. That was 3 countries. We are now negotiating with, depending on how you measure it, maybe 150 to 170 countries, all at the same time. Now, clearly, if it took 18 months to negotiate with just 3 countries, at a time in which those negotiations were fairly obvious, these are 3 countries that are so intricately tied from a trade perspective that a deal made sense, well, how long do you think it should take to negotiate with many more countries? And so with the presence of a Supreme Court decision sometime in November on the legality of tariffs, there's a big cloud hanging over the head of trade negotiation. And with some uncertainty about what direction tariff rate policies will ultimately settle, we have seen higher rates on tariff, 19% roughly right now, than we have seen since World War II. I'm going to tell you right now, businesses know how to navigate that number. They can change supply chains, they can find ways to pass along costs. What they don't know how to navigate is the uncertainty. And so until we have some clarity on what trade policy actually looks like, well, as a business, I'm not terribly excited about building a new production line and hiring more workers. Forget for a second that maybe I can't find those workers. There are some of them out there, but I'm not terribly excited about making that spend decision until I know what that looks like. On the inflation side, certainly tariffs come across as higher prices to the extent that the importers pass them along to the end consumer. Here's that payroll growth number. I don't want to be, again, too flippant about how significant this slowdown has been. There are a lot of meaningful pieces of data that support why maybe this isn't as significant as it might otherwise seem. But you can see on average over the last 20 years, we've added 104.3 thousand jobs per month. Again, the months of June, July, and August, we added about 30,000. We are woefully below that rate of payroll growth that we normally see. And as I said, the thing that may save us is simply that we are going to make workers more productive. And by and large, that is the history of our country. We often talk about how we want to manufacture more in our country, and I think that's a meaningful objective in a lot of key areas. In particular, when you look at pharmaceuticals, in particular, when you look at key defense investment, those are clearly things that we as a government and we as a country should have a lot more control over. On the other hand, we actually do manufacture far more in our country than we have. And in fact, manufacturing growth has been fairly substantial over the last 40 or 50 years, even as manufacturing employment was shrinking dramatically. Two really big reasons for that. The first is the kinds of automation I was talking about earlier, those Miller Coors forklifts that basically can drive themselves around the warehouse. But the second is that as a country, we focused on higher order production. Instead of producing the tiny screws that go into the big airplane, we bought those tiny screws and manufactured the airplane. A, that needed fewer workers, but B, you can sell an airplane for a lot more than you can sell a screw. And so when you add up the value of the things that we produce, well, it was easy to say manufacturing output is growing even as we haven't needed as many workers to do it. And that is really the way out of the problem of having a smaller workforce, make those workers more productive. Here's that inflation chart. You can see average since 2000 is 2.6%. I will remind you that the Federal Reserve uses a measure called the Personal Consumption Expenditures Index as their preferred inflation measure. I made a promise up here last year that I would be consistent in the way that I report inflation. We made a choice at that time to use the Consumer Price Index. There are flaws to any of those measures, but for the sake of consistency, I will use the Consumer Price Index. And based on any of the measures you look at, inflation still runs well above the Federal Reserve's 2% target and on the order of what we have seen on average since 2000. And as I mentioned, we are seeing that inflation in some very particular areas. So when you look at the components of Consumer Price Index here, all items, we were as high as 9% going back to June of 2022. At the end of August 2025, sitting at 2.9%. If you strip out food and energy, we've actually seen a pretty significant step back in the cost of energy over the last, about year. You have a 3.1% rate of inflation right now. Now, all of you eat, and all of you need energy for things. And so, again, when I make a choice, I'm going to choose something that includes those things in which you are actually spending money on. But to get an idea of what that looks like, simply look at the fact that food has inflated at a rate of 3.2% year over year at the end of August. I will be clear in saying that the story for the rest of the world looks different. It is not that global trade is stalling, it is simply that global trade has shifted. There was a report out a couple of weeks ago, expectation that perhaps this trade war might have hurt China fairly substantially given the amount of import we get from China. China actually seeing record trade surpluses, despite the fact that we are buying significantly less from China than we have. And the reason for that is they have sent significant numbers of very low-cost electric vehicles into South America, Brazil in particular, into parts of the frontier markets, so parts of North Africa, the Middle East, and now flooding Europe with very low-cost goods in a way that we saw for a number of years. It is not that they are not selling those goods, it is that they are selling them in new places. And so we should be clear about what our objectives are, but also we should be clear that at the same time, the European Union, and Germany specifically, has committed €1 trillion to infrastructure and defense spending. That European NATO countries have now committed 5% of their gross domestic product, a number that, by the way, we very much wanted to see them commit to, because it meant that they were spending on their own defense, but 5% of GDP to defense. I want to be clear that we have at the very same time seen those same countries announce that that spending will be more and more taking place at home. Northrop, Boeing, Oshkosh Trucking, all defense contractors that could stand to benefit from meaningful defense spend. Instead, BAE, Saab, European businesses that do many of the same things are going to see a lot of that defense spend. And so as investors, it does make us rethink, how should we begin to allocate our capital? The last piece I would point out is that I anticipate that spending taking place to continue to be more insular as countries look for ways to negotiate this trade negotiation, this trade war. Here's that U.S. goods imports by country. You can see that bright red line, which in the kind of 2012 to 2016 became kind of the biggest source of global imports for our country. China taking a very big step back in terms of its contribution to the things we bring in. At the same time, Europe, Canada, Mexico, all changes here and there, but largely unchanged. All right, so that's a lot of words to talk about an economy that was on pretty solid footing, has slowed a little bit, but has a lot of good stuff going for it if we can get past some of the current uncertainty. I know that sometimes when you're in the middle of it, that feels hard. When you're driving through the fog, sometimes you wonder if you're going to get to the other side. We will. We'll get there. And of course, when we do, the question that's left is, what does it mean for our investments? So we actually have a fairly strong earnings forecast coming in large part because of that massive artificial intelligence spend. When we talk about companies like Oracle, Microsoft, Amazon, Oracle alone has a $445 billion sales backlog, much of that tied to its services infrastructure around artificial intelligence. These are real dollars being spent to you as shareholders via the mutual funds you own and sometimes the individual stocks, but to you as shareholders of those businesses. You will see the benefits of that spend. It's why you buy those businesses. The other important point to note on that artificial intelligence spending that I'm talking about, in addition to the benefits it has to the productivity of our economy, is that that spend is coming from businesses that have cash. They do not need to go to the market and borrow. They do not need to trick investors by adding a .com to the end of their name into believing that they are a good investment. They already have real products. Most of you have interacted with Amazon in some form or fashion, probably on the consumer side. What many don't know about Amazon is that a lot of the future growth potential comes from AWS, from their actual web services business. I have the good fortune, or maybe bad fortune, depending on who you ask, of driving past the Microsoft data center that's being built in Mount Pleasant, nearly complete at this point. They've already committed to 2 additional properties in the area. Conversations about another property. I know a lot of you are aware of the one that they had in mind for Port Washington. There are clearly dollars being spent, and it isn't just magic. You can see them. They are physical things being built right now. I want to point out, though, that the broad market rally we have seen this year and what we anticipate going forward is not strictly those few tech names that are directly tied to artificial intelligence. Our own business has the potential to be meaningfully disrupted by artificial intelligence. Financial services more broadly. If you are a risk manager at a bank, so one of your jobs simply, hey, let's make sure that the money we are lending out is being lent to good places. Let's make sure that the customers coming in to ask for big checks are doing it in ways that are probably not financing some kind of bad actors. And I'm going to tell you that software is actually really good. General artificial intelligence is actually really good at noticing those kinds of patterns. And so if I'm U.S. Bank, which I can see staring out my window every day, odds are I can maybe replace a few people with some software. Yeah, that's a big spend up front. We are seeing it in those massive backlogs. But at the same time, if I can keep headcounts down, by the way, at the same time that there aren't enough workers in the workforce, well, okay, I can maybe drive the bottom line a little more. But it isn't strictly cutting costs. We're also seeing these kinds of systems used to reduce friction. Well, less friction. Hey, I'm going to call in, and instead of having to press 0, I'm going to talk to an agent. It's not a person per se, but it is someone that can better understand my needs. I'm going to talk to an agent that can maybe better help navigate this point of sale. And so when we look at some of these things, yeah, near term it feels kind of scary. Yeah, they're a little eerie right now, but as they get better, we'll know less and less when we're interacting. And again, sometimes for better, sometimes for worse. I would add that there is an immense amount of utility infrastructure needed for these projects. There is an immense amount of water needed to cool these data centers. All of that is spending that is taking place, which is ultimately driving returns in many other areas as well, from material stocks to utilities to all of the industrial manufacturers that make all the heavy equipment necessary to do this. So as optimistic as I am, and I actually am pretty excited about where this is headed, there are an immense number of opportunities. The challenge we face is that after 3 really strong years for the stock market, valuations are quite stretched. Here's your earnings per share forecast looking out to 2027. Obviously, really easy to say that looking back from 22 to 23, 23 to 24, we were seeing about double-digit rates of earnings growth. Your stock mutual funds that you own in your portfolios were up 50% to 100% more than that. So again, the price to earnings ratio, what we use to kind of figure out are stocks cheap or expensive? Well, the price piece has been going up faster than the earnings piece. Stocks have gotten more expensive. We should, hopefully, grow our way out of that problem, but it means one of 2 things. Either earnings really need to materialize in the way I'm showing on this piece of paper. These aren't my forecasts, by the way. These come from IBES or a survey of market forecasts. But we need to see that materialize. And then beyond that, we need to see the stock market continue to support that. As I mentioned, returns recently have not come strictly from tech. Historically, tech filled kind of the growth bucket of your portfolio, and you could think of the value side of your portfolio as a lot of those older players, the industrials, the utilities, some of the old guard banks. As you can see here, and I know it's a little hard given the color differences, but the bar chart on the left for each of these time series, year to date, 1 year, 3 year, 5 year, is your value stocks, your large value stocks here in the US. The stocks on the right, the Russell 1000 Growth. What we have seen so far this year is that value stocks have largely kept up. That shifted a little in August, and especially in September, we started to see those growth stocks rally even more meaningfully. But value stocks are not as far behind as they were, especially when you look at, for example, a 3-year return on growth that is 25% a year and a 3-year return on value that is 12.9. It has been a much more broad-based rally. I mentioned that stocks are expensive. The average forward P ratio for the S&P 500 going back to 2010 is 17. A lot of reasons why I think we as investors should be willing to pay more than that. Businesses in the S&P 500 today are far more profitable than the businesses that were in the S&P 500 10, 15, 20 years ago. The reality is that 10 businesses make up 40% of the S&P 500. Those 10 businesses are exceptionally profitable. They have very high margins. And as investors, they represent some of the best growth opportunities. On the other hand, there are a lot of other great businesses out there that are also expensive. And so when we look at history, well, the upper kind of 2/3 of time, those stocks should be somewhere under 20 times forward earnings. Right now, we're trading at north of 22 times. The story is a little different when we look at the rest of the world. The artificial intelligence story, not strictly a US conversation, although many of the tech businesses are, at least the traditional tech businesses, are more US-centric. What's lost in that story is that none of the technology that's out there today is possible without a large number of businesses that exist in the rest of the world. And specifically, when you think of the ability to do the computing necessary, you need the GPUs created by NVIDIA with semiconductors printed by Taiwan Semi, printed on lithographs that come from ASML, a Dutch company. This is a global supply chain for a technology that I think, again, is one of the driving forces behind the potential growth going forward. And so when we look at those stocks around the world, it's important to note that they are not nearly as expensive as the stocks here in the US. As importantly, and this has been a much bigger part of the story this year, the dollar has weakened substantially and is likely to weaken further, especially if the Federal Reserve is going to continue to cut interest rates. That dollar weakness has driven strong returns overseas. So just to give you a quick example, I'm sure most of you are big chocolate fans, other than maybe those of you that get migraines from eating it. But if you want to buy Nestle, Nestle is a Swiss company, makes some of the best chocolate in the world. I'd add baby formula, all kinds of other consumer goods that they sell to markets all over the place. But you need Swiss franc to buy Nestle. So as a U.S. investor, I take my dollars, I buy franc. Now I take my franc and I buy shares of Nestle. Now let's just assume for a second that it wasn't a great investment. It didn't go up or down. It just stayed the same. And now I sell my shares of Nestle. I get back franc. And as a U.S. investor, I want back my dollars. Well, in the time I owned those shares, the value of the dollar went down 10%. I'm going to be able to buy 10% more dollars simply because the value of the dollar went down, even as my shares didn't go up or down in value. And so one of the things we have seen is a meaningful return contribution from foreign currency. I expect that to continue. And the remaining challenge, despite the fact that we have gotten some clarity recently on at least some of the global tension that's out there, is that there are a number of things still going on geopolitically that make me nervous. Despite those things, and despite some countries that maybe are challenged, there are a lot of great businesses around the world. All right, so here's that chart on global valuations. You can see the S&P 500 historically, this is on a trailing basis, trades about 16 times the last 12 months earnings, not the next 12 months. Right now, trading at 22 times, so meaningful premiums. On the other hand, the MSCI ACWI ex-US, ACWI simply means all country world index, excluding the US here, trades at about 14 and a half times last 12 months earnings. That is just a small premium to what we have seen historically. And I should add that foreign stocks tend to be much bigger dividend payers than stocks here in the US. And so in addition to be able to buying them fairly cheap, you also get a higher dividend payment on average from those global stocks. Here's that conversation on the dollar weakening this year. Again, about 8 to 10%, depending on what currency you're looking at. Wall Street Journal publishes a dollar index, which just gives you a basket of currencies to compare it to. You can see, again, historically, we had been in a period of meaningful strengthening. And really, it has been since about the start of the year that the dollar has started to turn the other direction. All right, so we talked a little bit about stocks and where some of those opportunities are. I want to talk just for a second about bonds. Investor expectations have shifted meaningfully as the conversation from the Federal Reserve has shifted. We did finally get another interest rate cut at the last Federal Reserve meeting. We've got another meeting at the end of the month in which investors broadly expect another quarter-point cut. The market generally believes we'll get another quarter-point cut before the end of the year. And so for those of you looking at your bond portfolio, falling rates tend to boost bond prices. If I own a bond that's paying 4%, and now a new bond that looks pretty much the same as issued at 3%, well, any investor out there would rather have my bond that owns 4 than the new one that pays 3. And so demand goes up, the price goes up. The problem, of course, with bonds is that eventually they mature. And when they mature, you stop getting that 4%. And if it matures into a lower rate environment, well, now our expectations for bonds going forward have shrunk. And so it is a double-edged sword. On the one side, we would be happy to see our bond prices go up. On the other, I'd much rather be paid 4 or 4.5, as we had seen kind of at the peak for the next 10 years, as opposed to 2.5 or 3. And so compared to stretched valuations on U.S. stocks, actually what we see in the bond market is relatively attractive. There is a temptation, however, to overreach. There is a temptation to say, yeah, maybe 4.5 is fine, but I see that bond that pays 6. Why don't I go get that? Well, a reminder that nothing is for free, and that there is probably a reason why that bond fund pays 6 instead of 4.5. We are not being properly compensated for those risks in the bond market right now. The last piece I will offer is that probably more than we have seen in a very long time, municipal bonds are actually a fairly attractive investment for taxable investments. Not your IRA, Roth IRA money, but money in accounts where you would otherwise be taxed on the interest. Here's how that yield curve has shifted. So very simply, the far left-hand side of this chart, looking at the end of the year 2024 and going all the way back to the end of 2022, and then where we are today, the far left-hand side is what do very short-term overnight rates pay. The Federal Reserve only controls the overnight lending rate. And the far right-hand side, what are you getting on a 30-year? These are all Treasury bond yields. So you can see that we have seen a meaningful shift down in rates on the short end of the curve, those overnight rates. And yet, as we look further out, we have not yet seen much reflection of those lower rates come across in the 5, 10, 30-year bonds. The reality is that as the Federal Reserve cuts rates, the rest of the market is already anticipating those rate cuts. They are anticipating some uncertainty about the future, and they are not demanding for a 3-month bond what they otherwise would because they know that the rest of the market is going to come around to that. When I say that bonds look attractive relative to stocks right now, some of you may have seen headlines, well, first, 2 years ago or 3 years ago, that the 60-40 portfolio was dead. I would argue that balanced portfolios have worked about as well as we have ever seen this year. But I would also add that the headline has now changed to perhaps the 60-40 portfolio is supposed to be the 40-60 portfolio, reflecting the fact that when you have to buy expensive stocks, your return expectation going forward is a little lower. On the other hand, if you can get paid well for bonds, well, that seems like a fairly good deal. And so what I'm showing you on this chart here is simply what should investors expect for $1 invested in the stock market, the S&P 500, versus what should they expect for $1 invested in a 10-year Treasury? We're seeing somewhere north of 4% right now in the 10-year Treasury. It's changed pretty significantly day to day even right now with all of the noise that is out there, but somewhere between 4 and 4.25 over the last month, month and a half. On the other hand, okay, so back up. You put $1 in that 10-year Treasury at 4.25, you're going to get 4.25 cents in interest. On the other hand, I can buy the S&P 500 at current valuations. $1 invested in the S&P 500 is going to give me about 4.25 cents in earnings. Well, those numbers just about the same. Which one of those has significantly less risk? We all know how volatile it can be to invest in stocks. I'd much rather have a little in fixed income right now, a little more in fixed income right now. You have mostly seen that reflected in your portfolios. Here's why we don't buy junk. So I mentioned the desire to avoid reaching too far for yield. In the fixed income market, we call low quality fare the things that tend to pay higher interest rates because, candidly, as an investor, I demand a higher interest rate to take the risk. We call it junk or high yield bonds. High yield definitely sounds a little nicer, but certainly as we look at the historical premiums that investors demanded to take that risk, we are nowhere near those levels. And so I would mostly avoid the desire to reach too far there. Again, I mentioned municipal bonds, a pretty attractive opportunity right now. A lot of it depends on tax bracket. The higher income you are, the higher marginal tax bracket you are in, the more municipal bonds make sense, because the benefit of municipal bonds is that they are federally tax exempt. Now, again, we've got a lot of conversation on alternative minimum tax, that AMT thing that catches a lot of us, a lot of conversation on state tax exempt versus not state tax exempt. Strip all that out for a minute and let's just simplify the math. So if I were to take an average taxable bond fund right now, a bond which if I am paid the 3.99% interest, I am going to owe income tax on that interest. On the other hand, I can buy a municipal bond fund that on average is going to pay 3.47%. Well, if I'm not paying federal tax, it's not really 3.99 versus 3.47. Now I have to do some math on what we call tax equivalent yield. So in the 12% federal tax bracket, which most of us in this room are at least in the 12% federal tax bracket, the equivalent yield on that municipal bond is 3.94%. We are almost all the way in a very low tax bracket to what we could otherwise get in taxable bonds. You find yourself in that 32% tax bracket, as high earners or marginally high earners are, all of a sudden that 3.47% looks like 5.1% in comparable yield from a taxable bond. And so in addition to having a very attractive yield, municipal governments are actually quite strong right now. Property values have gone up, and so property taxes have gone up. Consumers are spending, and so sales tax revenue is quite high. Municipalities, by and large, able to pay back their debt. Some places maybe we want to avoid out in New York, California, parts of our friends down south, but by and large, municipals represent a pretty meaningful opportunity. All right, what's all this mean for your portfolio? I think that's probably why most of you are here this evening. Candidly, if you gave me a check and said, what would you do for the next 10 years? And you said, I'm not going to call you, I'm not going to ask, the stock market's the place to be. There are so many opportunities that it is really hard to ignore, even at these prices, what will come. The reality is that I'd like to see all of you somewhat frequently. I'd like to review your portfolio and talk about here's what we see changing. And so you're not simply going to ignore the next 10 years. And so I'm going to show it in a second here, but most of you are familiar with our Efficient Frontier slide that's been at every seminar I think we have ever put on. But while stocks for the long run is still the right answer, the disparity between stocks and bonds has changed significantly. And I would add that our toolbox has some new opportunities. The other piece that has made its way into the seminar over the last few years is the role that cash plays in our portfolios. That is a far easier conversation when money markets are paying 3.5%, 4%, even more percent. But as I mentioned, the Federal Reserve is embarking upon another rate cut cycle. The likelihood of at least another 0.5% cut before the end of the year seems fairly high. And in that world, your cash investments are going to see rates fall just as quickly as the Fed cuts interest rates. And so we have to be more intentional with cash than we have really since about 2022 when the Fed raised rates as high as they were. And so to that end, I would challenge everyone in this room to be sure that they have enough in the bank, in the money market, and then look at what's left over after they've crossed off the enough box and figure out what they should do next. That isn't to say it should be invested in stocks or bonds. It is to say that we should be having a more intentional conversation about the role that cash plays for you. As I mentioned, non-US stocks do look fairly attractive, not only because they are cheaper than stocks here in the US, but also because they provide a different lever of risk than simply buying stocks here in the US. They are tied to different kinds of economic activity and to different demographic risks. Most importantly, it is never too late to reallocate your portfolio. One of the questions I get probably most often, Kyle, how often do you actually look at my portfolio? I'm guessing it's been on your minds at some point in time in your relationship with the firm. So we look at the broad list of investments that you all own on a weekly basis. We meet as an investment policy committee on Monday mornings to talk about the markets, the economy, whatever is going on, sometimes to moan about all the pain that we had to deal with over the weekend and sometimes to celebrate the wins from the week prior. But we meet to talk about those specific investments so that if there is something that we as a firm hold by and large, we can take action on that. And some of you have seen those changes in your portfolio. I will tell you that it is rare that one of those meetings causes a need for us to take action. The reason for that is we are looking for investments for you that we think we can own forever. We do not buy fads. We do not want to be subject to, well, this looked great this week, but next week it's going to be something different. And so, by and large, week to week, not much changes. On a quarterly basis, we are reviewing every one of your portfolios down to the position. Allocation, position, return, to make sure that there are no surprises. Your advisor knows you well. They have had numerous conversations with you about what you need, and if something is out of the ordinary, they will reach out. Again, the challenge there is that ideally we have set a portfolio, we have set a risk target for you that is appropriate. And that means that it's unlikely we're going to need to do much. The most important part of the conversation, though, is the conversation we have with you. It's why it's so important that you make it into the office, or that we see you on Zoom, or that we pick up the phone. Because what really changes the way we invest for you are the changes in your life. When we know that you have cash needs, we're going to set aside cash. When we know that there's something coming down the road that might be important, we're going to make sure that you've prepared for that. A lot of you, when you call to ask for money, for example, you're going to hear the question, hey, that's great, we'd love to get it to you. What are you thinking? What are you doing with it? It isn't because we're nosy. Maybe some of us are. But there have been far too many instances of people just simply being taken advantage of. And so one of the things we are trying to do in our conversations with you is get ahead of those conversations, get ahead of problems that might come up. If I know you have to put a new roof on your house, I'm not going to be surprised when you call me to ask for that. I was going to say 20 grand, but it's probably more than that because of inflation. But I'm not going to be surprised when you called to ask for that check. You told me you needed it. It's there, it's ready. On the other hand, if you call me and tell me that your grandchild is in a jail in Mexico, and they've asked that you don't tell their parents, my grandma had that happen to her, well, I'm going to ask some questions. And again, it could very well be that you have a grandchild that could wind up in a jail in Mexico, and I'm happy to help get that money to you to get them out. On the other hand, again, there are far too many cases out there of people trying to get a hold of what you've worked too hard to earn, and part of our job is to help you protect that. All right. Some of you may have noticed, as a few of my colleagues did, that the branding on this slide looks wrong. And branding, a really fancy word to say, hey, we used to be green and beige and now we're blue and gold. A lot of Marquette alum as part of the firm, and so we made a big push for a transition to the blue and gold. I know some of our UWM alum and others may not be terribly happy about that, but it certainly made me happy when we made that switch. And a beautiful new website. But this chart I've put up here is actually the one we ran in my very first presentation that I helped Bob prepare going back to 2013. Many of you have noticed how significantly this chart has changed over the years. It used to be that hook, right? That when you invested 100% of your money in bonds, that very bottom pie chart, all blue on the chart you see on the screen, when you put all of your money in bonds, you expected a certain level of risk and return. Risk on the bottom, return moving bottom to top. And if you did just a little bit in the stock market, counterintuitively perhaps, although we know from a Nobel Prize for Harry Markowitz and from studies subsequently that actually there is some math behind this, but that if you just added 20% of your portfolio to stocks, you could meaningfully increase your return, but also significantly reduce risk. Well, I'm buying a riskier asset. Why should my risk go down? Well, you're diversifying the portfolio. And then take a step further and add another 20%, now 40% in the stock market, 60% in bonds. And all of a sudden, you're back to a similar level of risk to that all bond portfolio, but an even bigger step in return. And as you make your way further out, eventually, that return expectation begins to diminish. Taking more risk all of a sudden doesn't make sense. And that's the way this slide looked for many, many years. And then we hit a world in which interest rates went to zero. And our investments in bonds didn't provide the same protection, but they still provided the same level of risk. And so, unsurprisingly, the chart started to shift. And these are 30-year look-backs, so it doesn't happen overnight. But give me 10 years of data, and I can make the chart look very different, because all of a sudden, Going from 100% in bonds to 20% in stocks and 80% in bonds was a big jump in return. And the diminishing returns from pushing further and further out the risk spectrum weren't as significant. And so we as investors said we should take more risk. It paid to take more risk. But I'm going to argue that now that we're getting paid to own bonds again, the next 30 years probably look a little closer to this. So those portfolios that were 60-40, and for many of you pushed all the way up to 70, 75% in stock, for those of you that really were gung-ho about taking those risks and could afford it, well, we've started leaning back the other direction. I have to be clear, for all of the negative that I can put out there, and there's plenty, it isn't that I am pessimistic about the stock market. I am as optimistic about ever about the way that businesses will navigate the future. And as investors, that's why we give them our money. We want to participate in that growth. The reason why we are more conservative, it pays to be more conservative. I can take less risk and expect a similar return. Here's the last one for me. In a world of uncertainty, again, we say that 20 years ago, we say that 60 years ago, you go back whenever you want, but in a world of uncertainty, we have to be paying attention. If I go back to January of 2019 and I set my portfolio allocation at 60% in stock and 40% in bond, 50% US stock, 10% international, 40% in fixed income. And I did not look at it until today. My portfolio goes from 60% in stock all the way up to 74% in stock. Not because I made a choice to reallocate my portfolio, your portfolio, but because I didn't do anything to bring it back to the level of risk it was supposed to be at. And so if you haven't reviewed your allocation, and even if you haven't reviewed the correct allocation for you in this new world, I would urge you, reach out to your advisor. It isn't a tomorrow conversation. I don't know what the market's going to do tomorrow. If I did, I probably wouldn't be up here. But I would. I love actually doing this. But if I knew what was going to happen tomorrow, yeah, okay. Let's do 100% stocks tomorrow because it's going to be up, and we'll go to 100% bonds the next day. But the reality is we have to set something that's appropriate for you. Thank you all for coming out. We very much appreciate it.